let's discuss basic accounting terms and conventions. Hello everyone. First, there are two types of accounting. A financial accountant prepares financial statements, performs tax calculations, and audits companies. On the other hand, a management accountant identifies the cost of a product or a service, prepares budgets, and makes financial choice decisions. Now, let's define some basic terms. Sales are when products are sold and revenue is created. Purchases is when a company buys stock that will be sold.
Trade payables is when money is owed to our suppliers.
Trade receivables, also known as debtors, is when money is owed by a customer. Also, a ledger is a book containing accounting information in the T account format. Further, income is revenue from sales, whereas expenses are everyday costs such as rent and wages. We would show these two things on the income statement, which shows how much money the company has made over a period of time, usually a year. This amount would be the income minus the expenses. Further, non-current assets are items that will be kept in the business for more than 1 year. For example, property and machinery. On the other hand, current assets are items that will be used within 1 year. For example, the company's trade receivables and cash. The opposite of a current asset is a current liability, which is money owed by the company that will be paid within 1 year. Likewise, a non-current liability is money owed by the company that will be paid after 1 year. The statement of financial position shows how much money the company is worth at a moment in time, which would be its assets minus its liabilities. Now, let's move on to some accounting concepts. One concept is going concern, which is the underlying assumption that the business will continue for the foreseeable future. Another concept is accruals, which is that transactions are reflected in the final accounts for the period in which they occur and not in the period in which any cash is received or paid. Also, the cost concept is that all transactions are entered at their cost. Further, the money measurement concept is that each transaction must have a monetary value. Lastly, the business identity concept is that the business has a separate identity from the owner. Now, let's consider some accounting conventions. First, prudence is that you should account for a loss as soon as it is known, but you should account for a profit only when it is realized. Also, consistency is that the accounts should be treated the same from year to year and across the group.
As ever, thank you for watching.